Okay, so this session here is all about the exchange rate, but just to go back a bit from what we were doing last time, which was all about the balance of payments. Do you remember this? Assess the contribution of supply side economics in improving the trade deficit. And really all it was saying was if you have free market supply side, labour market flexibility, intervention supply side, green revolution, or a fall in the exchange rate, or we can track loads of FDI like Southern Ireland, then everything will be okay. Okay, so you can remember doing all of that. Marshall-Lerner J-curve effect. Should we be concerned about a trade deficit? Yes, we should, because of fall in ADE. That could then lead to a fall in the exchange rate. That could then create cost-push inflation. Right now, in 2022, we had a pretty large trade deficit, which was 6% of GDP. A lack of confidence in the UK economy. Then we asked the question, which is worth a trade deficit or a budget deficit? Problems of a trade deficit all the way down here, fall in AD, fall in the exchange rate, greater instability. Speculators might start selling sterling, and that could create cost push inflation. Then we've got all the problems of a budget deficit on there. Conclusions, both dangerous. 2022, our trade deficit was 7% of GDP. This is really, really high, but we've also got high levels of national debt. Combination of both is not particularly good, which creates more macro instability. It really depends upon the size of the trade deficit and the budget deficit. And I would say right now, the trade deficit is getting very, very high, and that is getting to a rising level. Okay. So we're now doing exchange rates, right? The exchange rate is determined by the demand and supply of sterling. So therefore, if the demand for sterling goes up, then we can expect the exchange rate to also go up, as seen on this diagram here. So, for example, if there's loads of FDI coming to the UK, then there'd be increasing demand for sterling, therefore the exchange rate would go up. Or if there's an increase in exports, or speculators started buying sterling, or an increase in interest rate, hot money would come into the UK, or UK tourism became a hotspot, then we would get more demand for sterling. Second up, a fall in the exchange rate. Okay, what could cause that? Well, it could be a fall in demand or a rise in supply. So, for example, a fall in demand would be a fall in exports, a fall in FDI, a fall in tourism, speculators not demanding the UK exchange rate anymore, right? So that would lead to a fall in demand, or we could get a rise in supply, a rise in imports, FDI going abroad from the UK, a rise in tourism abroad, a fall in the interest rate, therefore hot money goes abroad, or speculators selling sterling. So here we've got a fall in demand and a rise in supply, and we can see therefore that the exchange rate will fall. In this case, very significantly from 1.2 euros to 0.6 euros from on there. Okay. How can the government intervene to influence the exchange rate? Well, they could. It's a line from the syllabus. The Bank of England, is that the government? No, okay, it's the Bank of England, could raise interest rates. Hot money would come into the UK, therefore the exchange rate would go up, or we could go out and we could buy sterling. I've just drawn this on here because this in 1992, from 1990 to 1992, we were in the exchange rate mechanism where the UK went for a semi-fixed exchange rate. Okay, so in this case, the government had to raise interest rates to attract hot money into the UK, and also they had to use their currency, the UK sterling. We had to use other currencies to buy sterling. Right. But eventually, there were so many speculators selling sterling that the exchange rate eventually collapsed and we fell out of the exchange rate mechanism, which is really a bit of a story. Maybe fixed exchange rates is not a particularly good idea for the UK. Next up, advantages of a floating exchange rate. Number one, the beauty of floating exchange rates. Falling exchange rate, falling export prices, rising import prices. Therefore, the balance of payments will improve as long as the Marshall-Lerner equation holds and the J-curve effect, but you would have done that in the previous video. We can have an independent monetary policy. We don't need to worry about what our interest rate is, because we can just let the exchange rate fall because it's determined by the supply and demand of sterling. Or we can just ignore the trade deficit as a policy objective because we can just allow the exchange rate to fall and then hopefully the balance of payments will improve. But, of course, that has not happened in the UK because our exchange rate has fallen all the time and we still have a very large trade deficit. Disadvantages of floating exchange rate systems. We could get cost push inflation because of the fall in the exchange rate. We could also get demand pull inflation because there'd be a rise in demand because There'd been increasing demand for exports. And we could ignore supply side reform. Fundamentally, a falling exchange rate will help our economy, but we may need to improve the supply side performance of our economy. And of course, the falling exchange rate might add to the cost of living crisis that we already have. And the UK exchange rate keeps on falling, and we still have record trade deficits, e.g. 2022, 6% of GDP. And also, if the exchange rate is fluctuating all the time, then we don't really know that the price we're going to get for goods, so that becomes more complicated. Advantages of fixed exchange rate. Certainty. So hopefully that will lead to a rise in trade because there'll be more things, because we know what price we're going to get for our goods, and discipline. It therefore means if our inflation rate is higher than in other countries, right, we can't just rely on the fall of the exchange rate to fix the problem. We have to fix the problem at source. So therefore, we'll be more disciplined. Therefore, if we have a trade deficit, we have to solve the problem. So therefore, we'll have the structural reform, improving supply side to make sure that we can compete with other countries. We cannot rely on the exchange rate to get us out of a problem. So, but for us to have a fixed exchange rate is really largely impossible because we go back to the exchange rate mechanism. We tried it then, and it ended in complete disaster. We had to raise interest rates massively. You all know the effect of rising interest rates. So it didn't work then. And fundamentally, we still need to sort out our supply side. Okay. Advantages and disadvantages of a currency union. The currency union, e.g., we have the euro. Now, fundamentally, the euro is not a great success. Luckily, the UK was not in the euro, which was a bit of a shame because the euro... when we were in Europe, we were part of the European Union, which is really good, but the euro was a complete disaster. Okay, but there are advantages of being in the euro. Okay, lower transaction costs. We don't need to change our currency anymore. Greater price transparency. We can compare our prices of our goods with prices of goods in other countries. There's more discipline in terms of inflation. So it'd make us undertake structural reform if our inflation rate was out of sync with all the other nations, eliminates exchange rate uncertainty, and hopefully will lead to an increase in trade. However, the disadvantages of a currency union. Think of Greece. It was an absolute disaster because when they had problems, they couldn't print money to get themselves out of the issue. They could not decrease the exchange rate because they're in the euro. Germany has got a great big trade surplus. Therefore, the demand for euro is quite high because of Germany, even though Greece was running a trade deficit of 10%. So Greece could not devalue its currency. So it was a complete disaster for them. Their GDP fell by 25%. Remember COVID? Our GDP then only fell by 20%, 19.6% to be exact. Overall, the euro has not been a success. So therefore, maybe we should not join a currency union. And that is the extent of the exchange rate. Okay, so we've done the balance of payments and the exchange rate, end of.